and this is of last week Gbpusd in the forex. So since I had promised you guys a trade breakdown, I'm here to deliver that. So first things first, I'm going to take you back into what happened last week. So basically, the past 3 weeks on the forex have been a down move, have been bearish overall. So when you look at the euro and GBP, they have all been bearish, while DXY has been doing the opposite, as it should. And this is why I always say you should use DXY. You analyze it so as you can probe your bias and determine where the forex futures, the forex pairs will be going to. Then you can use that in mind to find the opposite direction. So real quick, this was clearly weekly CRT, as you all can see, and by now you know, some of you do know about CRT, but you don't actually know how to actually enter, position yourself to profit on a trade. So as you can see, first things first, as I always say, before you take a trade, you need to be able to know why there is always movements in these charts, why price moves, why the markets are moving, why is there candles printing up and down. And before you can do anything else, you need to know that. And I always say there's only two good reasons why you'll see price move up and down. The number one reason is to seek liquidity. Okay, to seek liquidity, and the way it does this is through seeking highs and lows. Okay, so for example, price will move to go take out a high. After taking out a high, it goes to take out a low, and these highs and lows is where buy stops or sell stop are resting, and these sell stops or buy stops are liquidity. And we all know market seeks for liquidity, right? So knowing that is one thing. Then the second thing is that price moves to balance an imbalance in the markets, and these imbalances are fair value gaps, right? Fair value gaps, or filling other order blocks and filling other PD arrays on the charts. That's it. Those two reasons, once you have those in mind, then you can now head to the charts and start trying to frame trade ideas. So with that out of the way, as you can see, the past 3 weeks have been a bearish move, and not just for GBPUSD, but for both GBPUSD and Euro, while DXY on the other hand was bullish. All right, so the first thing to look at is time frame alignment. All right, before you trade in a CRT, you need to be able to know what time frame that CRT is traded under, and I'll give you simple pass through on that. First of all, when you're trading the monthly CRT, you look for your model one or your entries. So when you're trading the monthly CRT, you look for your entries on the lower time frame, and the lower time frame for that is the daily time frame. So your model one, your fair value gap, your IVG, your breaker block, or whatever you use for your entry is going to come from the daily time frame. Whereas for the weekly, you're going to look for your entries and targets on the 4-hour time frame. So for example, you have a weekly CRT here, you're going to drop down the 4-hour time frame, right, to look for your model one, your fair value gap, your IVG, your breaker block. And for a daily CRT, you have to drop down to the 1-hour time frame or the 30 minutes time frame. And for the 4-hour CRT, you are going to use this the most. For example, if you're intraday trader, for the 4-hour time frame, you look for your entries and targets on the lower time frame, which is the 15 minutes. Whereas anything below 4 hour, which is 1 hour, 30 minutes, or anything lower, you're going to use the 5 minutes for your entries. So with that in mind, this right in front of us is a weekly CRT, and the weekly CRT has to be traded on the 4 hour, as I've just told you that. So real quick, we're going to drop down the 4 hour. So 4 hour, So here it is, right? So as we all know, you make your CRT high and low, and then you drop down to the lower time frame to find entries. But before you drop down to the lower time frame to find your entries, your draw on liquidity must be clear, right? The draw on liquidity for your trade or for your setup must be clear. And for that reason, I will give you a quick example on that. So this is what our range looks like. We have the range high and we have the range low, right? So before it's purged, our CRT looks like this, right? There is a clear defined CRT high and a clear defined CRT low. But as we all know by now is that we're CRT traders, meaning that we trade ranges. Range trading is a different topic in itself. And range trading says that we do not do anything. We do not do anything within the range, in the middle of the range. We only look to trade at the high, extreme high, or the extreme low of the range. And what do we look for at the highs or the lows of these ranges? We only look for a title soup, a purge, right? We look for one side of the range to be purged before we are interested to look for a short or a long. So for example, here we do nothing, right? And that is it. This is the thing, the core basics of what you're going to know about ranges. No matter how good it kind of looks, as long as there is no purge, you do nothing, you take no trade. The other thing that you need to know is the drawn liquidity, right? So for example, on this trade, your drawn liquidity needs to be on the opposing end of the market. So meaning that if we're up here, my drawn liquidity has to be opposite of where I'm at. So here, my drawn liquidity was actually this other block, right? This candle here. Why is this an other block? It's another block because it took out multiple highs. Multiple lows to the left, as you can see here, and then we closed above, turning into another block. So that's one. So the other thing is these are the lows, right? These smooth lows here are also our drawn liquidity. That is one thing to have in mind. Then the other thing is a key level. So a key level has to give you a reaction, has to be the point on the chart where you're having a reaction. So look at this. We just took out this high. Okay. We just took out this high. This is one. We just took out this high, and this high is from this is January, right? This is a 6 months high, and as we all know by now is that highs and lows are key levels. So with that in mind, we have a clear defined key level. So first of all, when you're looking at key levels, there is a hierarchy, right? There is a hierarchy in which you look at these key levels, in that there's those that are the strongest, the most important, to those that are least important. And the most important are highs and lows. Remember what I said at the beginning of the video, in that the market seeks for liquidity, and the liquidity seeks is through buy stops and sell stops. And buy stops, they lie above highs, and these highs are previous monthly highs, previous daily highs, previous weekly highs, previous session highs, right? Previous year's highs, for example. So looking at that is very important. And then sell stops lie below lows, right? Like for example, this is a weekly candle, and this is the low of this weekly candle. So below these lows lies liquidity, meaning that once the market has taken out liquidity up here from this high, it will seek for first the 50% of the range where there is liquidity as well, and then the major liquidity, which is sell stops at previous weekly lows, right? And these are the lows resting to the left. Now that's out of the way. So the first thing is the drawn liquidity, which is our other block, this, and then these lows. The other thing is the key level. The key level is clearly this high, right? This high that I just showed you on the weekly time frame, it's a 6 months high. A 6 months high, meaning that it's a very important key level. So once that is defined and that is out of the way, we now drop down to the 4 hour, where we're going to find our entries on the lot time frame. All right. So here we wait for one side of the range to be purged before we can look to do anything. Okay. Exactly. So now we have that. So typically this is our model one. This is our model one, right? Why is it a model one? From so many videos that you've watched that I've already talked about, a model one is a thick up close candle that takes out a high, right? Or takes out a low, and when closed below, for example, this. So the purpose of this candle is that the market created a high, came and consolidated, up and down, and then use one thick up close candle to take out the high and use the next thick down close candle to close back in, right? So now, right the moment we had this thick up close candle, this is a turtle soup. This is a purge, a false breakout, right? A stop run. Why is it a stop run? To run out liquidity above these highs. So the liquidity lies in buy stops, right? There's buy stops, buy side liquidity. And then the market comes back in and closes back into the range. So that shows, first of all, once the market closes out, we do nothing until we close back into the range and close below the candle that took out the high. So right now we close back in and we have a model one. So model one is in place. So if this was your everyday CRT, for example, if it was a 4 hour CRT, you take your you'll actually take your entry. Your entry was going to be here. You would actually sell, right? So you sell, and then the first thing that you're going to target is the 50% of the range, and then the opposing end of the range. So let's see. So as you can see, 50% of the range is already met, right? And as already told you guys, once you reach 50% of the range, once the 50% is taken, you take off partials, right? You take off partials. By partials means that you take out a fraction of your position. If you enter with a lot size of like 1 lot or 2 lots or 5 lots, 10 lots, whatever you use according to your account, you take half of it, right? To secure that, so that in case the market does anything else, it is completely risk-free. So that's the number one thing. So right here we took out 50% of the range and we let it play out. We let the rest play out. And yes, then we have there. So this is where we have our target that's been taken, right? So that is one thing. Okay, that is one thing. So for example, if you were to take this trade, given that you're going to use this, and then you were to take this trade and enter right here, right? So since you have a close below and price came back, because what happens is that once we have a close below of this candle, right, which is our title soup, price usually and typically will come back to retest it, and the retest is where you have your entry. So we had the close below it, we came back to retest it, then our entry is in, stop loss above the model one candle, right? And we target first the 50% of the range and the opposing end of the range, right? That offers you a 7R. Okay, so basically this is what your trade would look like. I hope this is clear, right? This is a weekly CRT, and this same concept that I'm telling you applies to everything. I could actually hide these candles right now. I could hide the labels, right? 4 hour or whatever. I could hide this. You don't know that this is a 4 hour, or you don't know what time frame this is, but the concepts would work the same way, right? So this is basically the core concept of trading CRT. But you have to understand that all of this is necessary because the other factors that I've just explained to you are in place. Once those aren't in place, you cannot drop down to the lower time frame. Okay, you actually, matter of fact, you have no business on the lower time frame if you do not even know where the higher time frame is headed. All right, and this brings me to the other way to probe bias. I already talked about this, the wicks and closes. So once we have wicked, and for example this candle, right, wicked above the previous weekly candle, giving us a CRT, we can anticipate that the next one or few candles is going to be a bearish move, right? That is another way to probe bias. So wick above is lower prices. As you can see, this wick above is lower prices, whereas wick below is higher prices. You see wick below right here, for example here, wick below is higher prices, right? I could give you an example right here. See this wick below. So once we wick below that candle, our first target would be this high, right? So wick below is higher prices. And what did we have? We wicked below this candle and we had this up move, right? And then wick above. So we wicked above this candle and we had a series of next 3 weeks that are bearish, right? This is one way to probe bias. The other way is closes, right? Body closes. So close above means higher prices. Close below means low prices. So for example, right here, we had a close above this candle. So this would straight away determine that your bias was bullish, right? If you go down to the daily time frame, you would clearly find that there are multiple daily candles that are closes above, right? So to just cut everything short right here, the exact same trade idea that I want to talk to you guys about was this. The last pop before the drawn liquidity is met. And this is what we call a kiss of death, all right? A kiss of death is one of the entry models that you can use to enter trades. And this is exactly right here. So before this low was met, right? This is this same exact low. Before this was met, right? Price came and formed this. I talked to the members in my group and I told them we're going to be having a kiss of death, a KOD on Gbpusd, all right? And the way this works is that price will give you a CRT high and a CRT low and give you an entry and the delay. So right here, you had all this move that is going to the downside. But the final move that I was interested in was this last move right here. Okay? And this move is called a kiss of death, right? And the kiss of death that is one that you can always use if you missed an entry right from up here. So first of all, you had an entry here. Secondly, you had another entry here. You see price reversing back to this breaker block, all right? You could have another entry right here. And then, you know, there was like multiple entries, but then this is the most high probability that you will have alongside a more than one entry. A KOD is one that is also very high probability. So first of all, this was my CRT candle and I marked everything much before the market started to open. So right here, I'm looking for market to give me a title swoop. And here I have my fair value gap. So right here, we have a fair value gap. And this fair value gap was my key level. And my target or my drawn liquidity is still this low, right? So this is where I would say your title swoop has to happen in the opposing direction of your draw on liquidity. And I was expecting something like this, all right? From here, I was expecting a title sweep like this. Like this. This is how I wanted the move to happen. Alright? So this is it. I had a drawing like this and I sent it to my group, right? To my private group. And I told them I'm going to be looking for a sell before we can take out this drawn liquidity on Gbpusd, right? This is it. So that was the trade idea. And when you drop down to the lower time frame, it's even clearer. So right here, what we had was a breaker block. So why is this a breaker block? High, low, higher high, lower low, right? Then coming back on retest of this breaker block would be my interest to sell. And the sell would be from here over to here, the low that I'm interested. Remember, the low is the weekly low, right? But I also have another CRT on the lower time frame that is leading me to the direction of the higher time frame. And this brings me to another point. A CRT on the lower time frame that is in the direction of the higher time frame is the most high probability. I'll repeat that again if that went over your head. A CRT on the lower time frame that is in the direction of the higher time frame bias is the most high probability CRT you would ever catch. So what this actually means is this. All right, the weekly bias is bearish, right? The daily as well is bearish. All right, so if the weekly is bearish and the daily is bearish, and then dropping down to the 4 hour, and the 4 hour CRT that I'm having is bearish, because I cannot have contradicting bias on the lower time frame when the higher time frame is bearish, right? For example, it would be so wrong for me to look for any CRT on the lower time frame that is bullish, yet on the higher time frame we are bearish. For example, you look at this CRT right here. Okay, let me just give you an example, and this is going to be the reason why your CRT fails. All right, this actually didn't fail like 100%, but it didn't deliver 100% the way you'd want it to. So you would think this, right? CRT high, CRT low, title sweep. You expect this to deliver up to this high, but it didn't, right? Why? Because you are trying to buy on the lower time frame, while the higher time frame, which is the weekly and daily, are bearish, are selling. You see that? So you're actually fighting against the bias, and this actually does not work. So 9 times out of 10, your CRT will fail to work because you are fighting the bias. You're going against your bias, right? So right here, since I told you my weekly is bearish, the daily is bearish, and now my bias on the 4 hour is bearish, it makes it a very high probability setup for me to take, right? I can confidently put in a position on this and sit back and let everything else play out because it's a part of my system. Once you go down to the 2 hour time frame, you realize that there is a breaker block, right, that is lying there waiting to be retested, right? And then I'm going to be selling. If you even go down lower to the 1 hour time frame, all right, here's how everything gets fun. So right here we have a BPR. Okay, we have a BPR, and the BPR, as I already mentioned to you guys by now, is one of the most high probability that you'd ever take. This is simply fair value gaps crossing each other, right? So this BPR is where I was interested to sell, and my sell was basically this. It had to be above the open of the daily, which is 12 midnight, right? 12 midnight was when I was looking to sell above 12. So let's see what happens. You see that? Exactly. And we have a CRT low has been met, right? So you've seen this. I've just showed you an example of what it is I was looking for. right? So we had a turtle soup. I remember this was the day it was PPI. Yes, we had PPI, high impact news. So this was actually the turtle soup I was looking for. As you can see, I have my arrows marked here, and exactly we got that. So we had a turtle soup above this high into the BPR, right? And this was when? This was at 8. This was during PPI. And this brings me to another point. High impact news are nothing but manipulation. All right? That's the story for another day. I can go into all of that. But as you can see, this delivered, right? It delivered us to CRT low. And pretty much that was the whole trade idea. So I hope you see it, right? Because the way this works is that these concepts are going to play out in your eyes every single day, and they will be here to play out the same way. Nothing is actually going to change. You just have to get better at looking for these opportunities, and everything else will clear out of the way. So that was basically the trade idea, and yeah, I just wanted to take you guys through this so that you guys see the logic and the narrative behind the trade that I took. You see, this is not actually hard to understand. It's not actually rocket science. It's basically just simple practice. Once you do something over and over again, it becomes like second nature. You know, you just know what to do. Like, you just look at it and you know that I'm gonna do this. So this was actually the trade idea, and I wanted to give you guys a quick pass through so you can see what was the logic behind all of this. So as I say, be sure to study this with a notebook and a pen. Take some notes if there's something new you heard today, and be sure to add it to your trading. This is how everyone grows. This is how I had to grow, right? Every trader has to grow or has to learn, has to see something, write it down, practice it, right? You have to be able to verify the things that I'm telling you here. See them by yourself. And once you see it, and now you have the confidence, then you can now risk your money on it because you've seen it work, a lot of times. So with all that being said, I hope you have a good week. Happy back testing, and I wish you a good week.